stage 6, value of the business. So how will the value of business arise or found out? So the value of business, remember, present value of future cash flows of explicit forecast period on one hand, and present value of future cash flows of the terminal period on the other hand put together of this hotel will be the value of this hotel, right? So the parking by Radisson in Nagpur, we done the cash flow for explicit forecast period. We have done the cash flow for the terminal period. We also have found out the growth rate. We also have found out the cost of capital or cost of equity in this case. And based on that, what we do, we find out the present value of future cash flows for the explicit forecast period and also for the terminal period. And when we add them together, that becomes value of the business as such. So this is the value of the hotel as a property using the discounted cash flow method. Now let's look at the 3 steps to valuation of the company owning the hotel property. So what we have done so far, we have done the valuation of property as such using the discounted cash flow method. Now if we have to do the valuation of the company, then some adjustment will need to be made for finding out the value of the company using the same discounted cash flow method. So what adjustment do we need to make and why? So we need to make certain adjustment on account of surplus cash. We need to make certain adjustments on account of non-operational assets. Please understand why. Why do we need to make adjustment of the surplus cash or of non-operational asset? So from point 1 to point 6, we did the valuation of the hotel as a property using the cash flow of the hotel. Now, if we have to do valuation of the company, then what we need to do? We need to, number 1, pick up the value of hotel as a property and make some adjustment to find out the value of the company. And what adjustment do we need to make? Number 1, it is possible that the company may be carrying some surplus cash or company may be carrying some marketable investments. Now these investments or this surplus cash which is lying with the company will not reflect in the value of the hotel because you have done the value only of the hotel. So the cash that the company is carrying, the marketable security investment in marketable securities that the company is carrying, or any land parcel which is lying somewhere which is not part of this hotel property, that also will need to be adjusted. So first of all, adjustments will need to be done for these 3 factors, including guarantees that the company may have given. So if the company has given certain guarantees in favor of someone, then there is a likelihood of some liability devolving on the company in future. So the value will, for arriving at the company's value, the value of the likely liability of the company on account of those guarantees will also need to be deducted from the value of the hotel. Surplus value will need to be added in the value of the hotel property. Non-operational assets will need to be added to the value of the assets. Then there may be some other adjustment on account of discount of lack of marketability or discount of for lack of control. So it is possible, when you are making an investment, you may be making investment in a company which is not listed. So that means what? That means you will have a difficulty of marketability. You will not be able to freely transfer your investment, and therefore you may expect some discount on account of the lack of marketability. Likewise, it is possible that the chunk that you are buying of that hotel property is not sizable. It is only a minority interest. Since you are only acquiring a minority interest, it is possible that you will not have any opportunity of exercising control on the hotel. So since you are not able to exercise any control in the management of the hotel, since you are a minority stakeholder, and therefore you can expect some discount from the seller. When you're buying, making the investment from the seller. So these are the adjustment that you will need to make. You will also need to make a control premium. So in case if you are selling a stake where that stake is going to give control in the hands of the buyer, or when you're buying the hotel and the investment that you are making is going to give control in your hand, that means you would be able to influence the decision making of the hotel management, and therefore the seller in that case may ask for certain premium. So that is these are the adjustment that will need to be made when you are uh, doing the valuation of this 5-star hotel. uh, Stage number 8, valuation arrived after making the adjustment will be enterprise value. So if you have used the future cash flow for the firm, then it's going to be enterprise value. And if you have used the future cash flow for equity, it is going to be equity value. And that's your stage number 8. And finally, we come to the stage number 9, and that is dividing the enterprise value or the equity value by the number of shares will give you enterprise value per share, or it will give you equity value per share. So friends, this is how you will do the valuation of a 5-star hotel using the discounted cash flow method comprising of 9 different assets. So with this, I come to the close of what I had to share with you, and maybe now we can make it open to everyone for raising their questions and their doubts, and I would be very happy to take them. Thank you.